this video, we're taking a deeper dive into bonds. Specifically, we're looking at credit spreads. We're going to use the Federal Reserve Economic Data Tool, abbreviated as FRED. It is widely accessible, it's free, and you can use this to access credit spreads at any given time to see what they are. Let's take a look at these and talk through some scenarios. This credit spread chart, the time frame we're looking at is 2016 through 2020, and the line we're looking at is the actual credit spread itself. This is the yield on junk or high yield bonds compared to the yield on treasuries. We take the treasury yield, subtract it from the high yield bond yield, and the difference is graphed on this chart as a credit spread. If you look at normal movement here as the market's appetite for risk is increasing, you're going to see spreads narrow like we saw throughout much of 2016 into 2017. Spreads then stayed within a range for some time, and as we got into the second half of 2018, what we saw was equity markets were starting to decline, the S&P sold off, and at that time risk appetite was diminishing and spreads widened out. Then you get into 2019, the S&P had a very strong return, investors were showing a willingness to accept risk again, and spreads narrowed. Then we saw a bit of trading as spreads expanded and contracted, till we get into 2020, where we have a global shutdown due to COVID. This is what happened, and then the government quickly stepped in to support the economy, and what we saw was spreads responded equally as rapidly. So we had a very sharp spike in credit spreads, followed by the government running a number of programs and injecting liquidity into the marketplace, which in turn made investors more willing to accept this risk, and spreads contracted. So let's think about what assets do well when spreads contract and which assets get hurt when they expand, because this will help us when there's a panic in the future. Whether you have bonds in your portfolio or not, there should be some takeaways that you can get just by looking at the credit spread. And then if you are playing bonds, certain ones will react in a much more notable fashion than others. So first of all, the lower you step on the credit ladder, the more of a price movement you'll typically see when spreads expand and contract. So at a time like this, the lowest quality bonds are dropping more than high quality bonds. When the contraction occurs, the opposite is true. Those same low quality bonds are able to recover quite a bit more of their price than a higher quality borrower would. So on the corporate side, you can look at a corporation's credit quality. You can look at the credit rating on an individual bond issuance. On the municipality side, we've seen some interesting plays here as well. So I'm going to actually widen this time horizon a bit, and now I'm bringing in 2008 and 9. And for those of you that were investing in both COVID and the 2008 and 9 situation, this is going to be quite familiar in your mind still, I would imagine. If you were not investing in 2008 and 9, take a look for a moment at the scope of credit movement we were dealing with over a decade ago compared to 2020. Credit spreads widened out quite a bit more. If you look at where they are here, we're north of a 21% credit spread between high yield bonds and treasuries. There was a true panic. Investors were questioning the strength of the financial system as a whole. You had certain financial companies that were imploding, and the government took action, but they took it in increments. You had a TARP program, then you had what came to be known as quantitative easing, QE 1, 2, and 3. And as these programs were put into place, credit spreads did respond by narrowing, but it took some time. The response from the government was not as dramatic in scale as what we saw in 2020, and in turn, the credit spread response came much quicker this time around in 2020 compared to 08, 09. So in 2008 and 9, municipalities saw their bond prices impacted to quite an extent, and it depended on the credit quality of that municipality. A city or town with a low credit rating saw their bond prices drop considerably as these spreads expanded. And investors were able to pick up municipal bonds, either individual issues or bond funds, and actual returns coming off of this widening. So if you were investing while spreads were in this very wide range, you saw a strong yield, and in addition you saw capital appreciation in those bonds as it narrowed. I'm not even going to get into the returns experience in that time because I wouldn't want you to have that expectation going forward, but if you're curious, go back and pull the returns on lower credit quality bond and municipal funds back in 2009 into 2010. You'll see some strong yield performance and some strong total return, which will be yield plus capital appreciation at that time. The main takeaway that we want you to understand when you're looking at credit spreads, number one, this is a tool to stay informed about the risk appetite in the marketplace. If spreads are expanding, then investors are showing more risk aversion. If they are contracting, then investor appetite for risk is increasing. That's one piece, the actual direction. The other piece is understanding where they are in a historical context so that you can say, okay, are we in a time right now? Let's look on this chart, for example, from 2017 through much of 2018. That's a time that historically investors were showing a very high tolerance for risk. So that could set the market up for a dislocation if it occurs and when it occurred. Compare that to investing at a time where rates have just spiked. And we see this, it's not just extremes like COVID. If you look at, I just highlighted in 2016, had this again in late 2011. So you're going to see some movement without the dramatic headlines that necessarily, COVID, a global shutdown, or a global financial crisis would bring. So start watching these credit spreads. As spreads are increasing, get a sense for what equity markets are doing. As spreads are narrowing, get a sense for what equity markets do in that situation. In particular, which industries fare better during a widening or during a spread contraction. Utilities, for example, are more yield sensitive and react very differently than high-tech growth stocks as these spreads move. So start to check this. If you're used to logging in and looking at a range of stock prices and financial data, add this to your list. Start to familiarize yourself with credit spreads. We've seen that it's a tool that is dramatically underutilized by both individual investors and professionals. It's a tool that can give you a lot of data, both on which asset classes are in and out of favor and which direction risk sentiment is moving. Now that we've taken a look at credit spreads, talk about what they are, how they move, and also shown you where you can access this data, start using this to understand where risk appetite is in the marketplace. Think about our spreads expanding or contracting. How will risk-based assets respond in that situation? Also, think about the types of bonds in your portfolio. So this is a useful tool even if you don't have bonds. If you're running an all-equity portfolio, it's still very useful for you to know what spreads are doing, how they're moving. But particularly if you own bonds, this should help you position a portfolio either high on the credit ladder or low on the credit ladder, depending on what you anticipate spreads doing. And if you're just learning this, you may not be in the spot of anticipating spread movements. You'll at least be able to see where they are today. It'll help you to put it in context. Are we at a time that spreads are historically narrow, showing that the market has a very good appetite for risk, or are spreads historically wide, showing investors are paying careful attention to risk at that time? So familiarize yourself with this. Start watching how equity markets move as spreads change, and this will be a tool that will help build your market knowledge.